And in my haste to get moving, I noticed the Minister hasn't yet arrived.
The Minister doesn't arrive for the RBA.
Oh, right. Okay. Very good. Well, we can kick off then. So the committee does welcome the Reserve Bank of Australia and its representatives, Governor Ms Michele Bullock and Assistant Governor Dr Christopher Kent. Very welcome here this morning, and over to you for an opening statement.
I won't make an opening statement.
No opening statement. Okay. Thank you very much. I might kick off, if I can, just with the first couple of questions. We've seen inflation moderate significantly from its peak in 2022. Can you just talk a bit about what's moderated the inflation and perhaps make some comments around whether it's been broad-based amongst a range of categories such as goods and services or other areas, and what this might mean for the moderation in a number of measures of inflation, please?
Sure. If you go back to when the inflation was at its highest, back at the end of 2022, when it hit 7.8%, there was a couple of factors involved in there. The first thing was that and this was around the world, inflation had risen substantially around the world, and there was a big supply chain issue associated with that. So you might recall during the pandemic, there were logistics issues, there was particular trouble with goods, getting goods to where they needed to be around the world, and that was creating supply chain issues, and at the same time there was energy price rises. The Russian invasion of Ukraine resulted in substantial increases in energy. So there was these supply side issues. There was also a sense in which demand was really strong, because around the world, again, and in Australia, governments had responded to the pandemic by increasing fiscal spending, which was appropriate. Interest rates had dropped around the world to practically zero, so there was a massive demand side impact. And what happens when supply chain issues meet strong demand, and we ended up with strong inflation. Since then, it has come down, and it's been for a couple of reasons. The first is supply chain issues have resolved themselves. Energy prices are still high, but they're not increasing at the same rate they were. And many other goods which were in short supply, their prices have stopped rising and in some cases declined a little bit. At the same time, interest rates had risen. They'd moved from very accommodative levels to restrictive levels, and that has dampened demand in the economy, and that's also what's contributed to the decline in inflation. So it has been broad-based. It has been broad-based across both goods and services, although I'd have to say that in Australia, like many other countries overseas, services inflation does remain a little sticky. It is higher. It's being offset by slightly lower goods inflation, but services inflation is still up around 3%, and in some countries it's a bit higher than that. So generally broad-based. There is a bit of difference, as there always is, in different components of inflation, but we target total inflation. We don't target individual components of it. So at the moment we're in a situation where we've got inflation back in the band at the moment. The key now is to make sure it stays there sustainably.
Thank you. And in terms of our labour market performance over the period, how would you say that the state of our labour market compares to the historical performance of the labour market over a longer period of time?
So I think if you'd said to us that we could have an unemployment rate with a 4 in front of it sustainably, if you'd said that back pre-COVID, I think people would have been a little sceptical, or some people would have been a bit sceptical. What we've seen is that the post-COVID low, if you like, of 3.5% unemployment, at that point, all the indicators were that the labour market was extremely tight. And when you've got a very tight labour market, that can put upward pressure on inflation. Since then, we've seen the unemployment rate rise to about 4.2%. I'd emphasise, though, during that period that employment has continued to grow. It's not that jobs are being lost, it's just that employment is growing, it's just not growing as quickly as the labour force is growing. So we have seen the labour market now ease. We still think it's possibly a little bit tight in some, particularly in some areas, but we think that's a bit uncertain. It could be close-ish to balance as well. There's a bit of debate about that, and we're open to those discussions. But certainly at the moment, I would say the labour market is in a pretty good place. The forward-looking indicators look reasonably stable. We're expecting the unemployment rate to drift a little bit higher over the rest of the year. But at the moment, I think the labour market's in a pretty good place.
Yeah. So, notwithstanding your comments just then about, perhaps what you might expect in terms of the labour market, I think what you're saying more broadly is that inflation is moderated, it's certainly gone down, and the labour market has remained resilient. Wages are growing. We heard this yesterday from the Treasury Secretary as well. In terms of what this means for growth in real incomes, are there, what would you say are the factors that are driving real income growth?
So at the moment, what's driving real income growth is wages are still rising, inflation has come down. If you're talking about real disposable income, then interest rates have declined a little bit as well, so that's putting money back in people's pockets, and there's been some tax relief as well. If you look back to what was driving the decline in real wages back a couple of years ago, the big components of that were inflation was really a very important part of it, and also tax was another part of it. Interest rates were part of it as well, but tax and inflation were the really, really big components. So as those things have reversed direction, we're now seeing growth in real wages, and in fact real per capita wages are now above what they were pre-COVID, so they've recovered that.
So overall that's a pretty good story.
Yes.
So I guess maybe just to finish off from me, and then I'll hand to my colleagues. In terms of, I guess, the return of real income growth, could you just talk perhaps finally about what it means for the economic recovery that we have seen? And maybe, we heard a little bit about this yesterday too from the Treasury Secretary, but from your perspective, which sector has been the key driver of growth in our economy? If you could highlight a couple of areas, that'd be helpful.
So for some time we've been expecting that as real incomes start to recover, that consumption will start to recover. So while real incomes were falling, obviously that wasn't good for households, consumers, and they weren't inclined to consume. We are starting to see that consumption is starting to recover now, and that reflects the growth in real incomes, and it also reflects a wealth effect. So as people are observing housing prices rise, perhaps they're watching the equity markets and they're feeling a little bit more wealthy. That also tends to result in people consuming a bit more. So what we've started to observe in the last little while, the previous year, probably a lot of strength was coming from government. What we're starting to see now is a bit of a switch between the public and the private sector. The last national accounts certainly demonstrated that the private sector, private demand was starting to now drive growth, and we're expecting that to continue.
Thank you. I'll hand to my colleague, Senator Patterson.